Hi everyone and welcome to English Speak Pulse. This is Danielle. Before we begin, I want to ask you something important. Something that every trader, beginner or advanced, secretly struggles with. Have you ever looked at a chart, seen a perfect setup, felt confident in your analysis, but still couldn't press the buy or sell button? Or maybe you finally entered a winning trade, but closed it way too early because you were scared the market might reverse? Or, be honest, you held a losing trade for far longer than you should have, hoping it would magically turn around?
And I am Sarah. If even one of those situations feels familiar, then you're not alone. These aren't strategy problems. They're not chart problems. These are emotional reactions, deep, automatic responses happening inside your mind. And today, we're finally going to talk about them openly. If even one of those situations feels familiar, then you're not alone. These aren't strategy problems. They're not chart problems. These are emotional reactions, deep, automatic responses happening inside your mind. And today, we're finally going to talk about them openly.
Because today, we're starting one of the most powerful and eye-opening lessons we've ever created. A lesson that reveals the real reason traders make bad decisions, even when their strategy is good. A lesson that explains why fear takes over, why greed kicks in, why hesitation appears, and why confidence disappears at the worst possible time.
Yes, today we're diving into the world of trading psychology. The hidden mental game behind every chart decision, every win, every loss, and every emotional reaction you've ever felt while trading.
So stay with us. Listen carefully, and keep your mind open, because what you're about to discover can change the way you think, the way you trade, and the way you understand yourself.
Ready? Let's begin.
We spend so much time on market analysis, refining entry points, optimizing indicators, all of that. But if we're honest, the thing that costs most traders the most money isn't a bad strategy.
No, not at all. It's the 6 inches between their ears.
Exactly.
Trading strategy is, of course, it's crucial, but it's the psychological part, the resilience, that actually turns a good strategy into consistent results. The market is all logic, but we as people, we're driven by impulse.
It's the ultimate paradox.
It really is.
So today we're doing a deep dive into excerpts from a guide on mastering trading psychology. Our mission here is pretty simple.
Right.
To give you the vocabulary for these emotional traps, the bad guys, and then find the one single skill, the hero skill, that keeps a trader disciplined.
And, the foundational technique in this analysis is, it's actually remarkably simple. The key is just to label the emotion the second it shows up.
Just name it.
Name it. You have to be able to say what you're feeling before you make the move.
Okay, let's unpack that. Let's jump right into the first and maybe the biggest challenge in the material, which is fear.
Classic.
Right. It's a classic trap, but it's so dangerous because it shows up in two completely opposite ways.
That's spot on. The first way is what they call the hesitation of entry. You've got a perfect setup, your plan is screaming buy, but that little voice of doubt, that fear of being wrong,
It makes you pause.
it makes you pause,
Yeah.
and you miss the move. You just sit there and watch it play out without you.
And the second one is, I think, even more painful, the premature exit.
Oh, definitely.
You're in a trade, it's going your way, and then you see one little red candle, one pullback, and suddenly that fear of losing the profit you have completely overrides your strategy.
And you close the trade. You snatch a tiny win when your plan was aiming for a huge one.
It's pure fear.
Pure fear of loss. You go from being a strategist to just a security guard for a tiny pile of cash. The analysis says you have to name it right then and there. When you hear, I have to get out now, you have to consciously say, this is fear of reversal.
But wait, isn't that just one more thing to think about when you're already panicking? The market's moving, you're stressed, and now you have to play psychologist.
That's a fantastic point. And yeah, if you wait until the panic is at a 10 out of 10, it's too late.
Okay.
That's why the labeling is a preventative measure. And it's why the source brings in a really powerful psychological tool to fight that fear, the stop loss.
I love this reframing because we always think of a stop loss as just a risk management tool, limiting your financial loss.
It's so much more than that. It's a psychological pre-commitment. When you set your max risk before you even enter the trade.
You've already accepted the worst case scenario.
Exactly. You've accepted it. And that acceptance completely disarms the fear. It gives you permission to enter a trade without panic. You're not trading on hope anymore. You're trading a system.
Okay, so if fear is the amateur's trap, the psychology gets a lot trickier from here. Because greed is often what gets the experienced trader. It only shows up after you've had some success.
And greed almost never travels alone. It's always paired with overconfidence.
Right.
It's that feeling,
Yeah.
of being invincible after you nail 2 or 3 trades in a row.
Yeah.
And that combination is just, it's toxic. It encourages you to just throw your rules out the window.
Yeah, the source material has this perfect little internal monologue. The trader thinking, I've won 3 in a row. I get this market now. I feel confident. Maybe I should double my position size on this next one.
And the immediate counterpoint has to be, the market doesn't care about your streak.
Right.
What greed and overconfidence do is they trick you into breaking your most important rule, which is position sizing. You go from risking, say, 2% of your capital to suddenly risking 10% because you feel lucky.
You're trading an emotional high.
Not the plan you spent months building. It's just arrogance.
Okay, so we have fear causing hesitation and greed causing these huge risky bets. Now, what about this third pair? The action paradox of hesitation and FOMO.
They really are 2 sides of the same coin, aren't they? Hesitation makes you wait too long because of doubt. And FOMO, fear of missing out, makes you jump in way too fast. Both are driven by emotion, not strategy.
That FOMO feeling is just agonizing. You see a stock going parabolic, your brain knows it's too late, but your gut is screaming, if I don't buy right now, I'm going to miss the whole thing.
That's the feeling. And the source says, when you feel that, you have to stop and ask, am I chasing this? Or is this actually in my plan?
And the disciplined answer is sticking to your rules, even if it means you miss out.
Missing a trade is always cheaper than forcing a bad one.
And if you follow that thread, it leads right to the next big one, revenge trading. This usually happens right after a bad loss, right?
Exactly. Revenge trading is just a cocktail of anger and shame.
Yeah.
You've lost money, and your immediate irrational goal is just to get it back.
You're trading out of spite.
It's the fastest way to blow up an account. You start increasing your size, jumping into anything that's moving, no analysis, just anger.
So how do you physically stop yourself in that moment? That trigger feels so immediate.
The key is a physical pause. Because it's such an intense, immediate feeling, the sources suggest you have to physically get up from the screen.
Just walk away.
Walk away for 5 minutes. That creates just enough space to let you label the feeling, okay, I'm angry and I'm about to revenge trade. And that's how you break the impulse.
So we basically spent all this time cataloging the enemies. Fear, greed, FOMO, revenge. And it seems like labeling the emotion is the first step for all of them.
It is.
So let's focus on the solution now. The ultimate skill. The hero of the story. Discipline.
Discipline is the hero. It's the one skill that lets you execute your plan, even if you feel all those other things. And it's not a personality trait, It's a learned behavior.
And the source material lays out this great 3-step loop for this. It's like an override mechanism you can drill.
We should really break this down. The loop is, first, identify the emotion. For example, I feel FOMO.
Yeah.
Second, check the rules. Does my plan actually say to enter here? And third, and this is the hardest part.
Act based on the plan, not the feeling.
That was the one.
Let's talk about that third step, because it sounds simple, but when there's real money on the line and you feel that tightness in your chest, acting against your own instinct it's incredibly hard.
It is. And that's why we have to refine what discipline really means. It doesn't mean you suppress the emotion. That's impossible.
Right.
It means you recognize the emotion is there, you acknowledge the fear, you see the greed, and then you make a rational choice despite it. The emotion is like a loud voice in the room, and discipline is the quiet rule book you choose to follow instead.
So if I'm terrified, discipline isn't about trying to be brave. It's about holding the trade because my stop loss already handled the risk.
Precisely.
And if I feel overconfident, discipline isn't about trying to be humble. It's just about sticking to my position size, no matter what.
Exactly. That acknowledgement is everything. The sources even stress speaking these thoughts out loud. Actually saying, I recognize the greed, so I'm executing the plan size. It helps build that mental muscle.
Discipline is stronger than emotions. It sounds like a constant mental battle.
It is a constant battle. The real challenge isn't winning one trade. It's maintaining that discipline over months, years, especially during a drawdown. You have to ask after every single trade, did I follow the plan or did emotion take over? Because if emotion took over, even a winning trade was just luck.
Absolutely. So the big takeaway for you listening is that the shortcut here is awareness. Identifying and labeling that emotion. That's the skill that interrupts the impulse.
And as we wrap up, think about this. We've focused on the big obvious emotions, fear, greed, anger. But the psychological guide suggests we also need to explore the more subtle emotions, the ones that seem almost benign.
Like what?
Well, think about something like impatience, or even simple excitement. Excitement feels good, right? It feels like optimism. But it often acts like a Trojan horse for greed.
How so?
It can make you jump into a trade too early just because you got impatient waiting for the setup, or it can make you take profits too soon because you just wanted the rush of closing a winner. If the obvious emotions like fear can derail you, how do you defend against the subtle feelings that don't scream danger, but just quietly chip away at your discipline?
That's something to think about. Welcome to the deep dive. So you, the listener, you're already putting in the hours. You're mastering strategies. You're looking at indicators, trying to define your edge. But there's this one variable in the whole equation that's just stubbornly human. And it's the one that costs most traders, well, everything, their psychology.
That is the absolute core of our source material today. It's, people don't fail because they picked the wrong moving average.
Right.
They fail because they let these emotional mistakes completely take over their rational decision making.
So our mission today in this deep dive isn't just to define the traps, right? Like impatience or fear.
No, it's to pull out the most powerful and I think practical mental tools, these little pattern interrupts that can lead you directly to what we call emotional neutrality.
And we have to start with this foundational conflict, I think. Successful trading is really just an exercise in waiting.
So much waiting.
It's discipline, it's patience, and often it's just long, boring periods of doing nothing. But our brains, the very organ we're using to make these calls, they are wired for the exact opposite.
Right. They want stimulation, action, immediate gratification.
And that's the battle.
It's a constant battle. It's your prefrontal cortex, your logic center versus all of your emotional wiring. And if you don't manage that tension, the market will find it and exploit it every single time.
That leads us straight into the first big one, the first hurdle that just undermines all that discipline. Impatience.
Yeah.
We talk a lot about fear stopping traders, but impatience is, I think, way more insidious because it actively pushes you into bad trades.
It's so dangerous because it doesn't feel dangerous. It masks itself as just, harmless eagerness.
Yeah, you start rationalizing.
You do. You start telling yourself, oh, the price is almost there, or you know what, this is close enough to my entry. But the market, the hard reality is it only rewards waiting for that precise confirmation. It never rewards a guess.
Okay, so let's make that concrete for someone listening. What does impatience actually look like on a price chart?
It looks like not waiting for the candle to close. You need it to close above a key resistance level, but you jump in while it's still moving.
Ah, okay.
Or it looks like entering a trade 5 seconds before a big economic data release because you think you know which way it'll go.
They're trying to front run it.
Exactly. It's that tiny gap, that few seconds too early mistake that our sources say again and again is what leads to people blowing up their accounts.
And the root cause isn't the strategy. It's just discomfort. Your mind wants that jolt of excitement, the payoff, but the market's just giving you slow, sideways, boring price action.
Precisely. And that leads to this idea of trading boredom. A lot of these impulsive trades, they're not driven by a real market setup. They're driven by a trader just trying to relieve their own boredom.
So you're trading your feelings, not the chart.
You're creating your psychological state.
Okay, so here's the key then. If you miss a trade because you were patient and it never quite hit your mark, you didn't actually lose anything.
No, you won. You saved the quality of your decision making. And that's the insight here. You have to focus on the quality of the decisions you build over time, not the outcome of one single trade.
So how do you fight that impulse in the moment?
You need what we could call cognitive anchors, something for your brain to hold on to. Instead of just letting the impatient feeling win, you need these defined internal pattern interrupts.
Like a mantra or something?
Sort of, yeah. The research points to these simple, repeated statements that are framed as a promise to yourself. Something like, I will wait for my setup because discipline gives me better trades. It gives your logical brain something solid to grab onto when that emotional tide starts pulling you.
Okay, let's dig into the biology of this. Because when we say emotions are taking over, it's not just a figure of speech. It's a chemical event.
Yes, and this is so critical. This is why discipline fails. When you're staring at a chart, at the patterns, the movement, the uncertainty, your brain is firing off signals.
So fear hits one button.
Fear triggers the amygdala. That's your primal alarm system. It wants an instant reaction. Greed, on the other hand, floods your system with dopamine.
The feel-good chemical.
Right? It creates this powerful, addictive loop. The anticipation of the win is the drug.
So what's the practical result of that chemical flood when you're trying to trade?
Well, when your amygdala and dopamine centers light up like that, they effectively hijack your prefrontal cortex,
The logic center.
the part of your brain responsible for planning, risk assessment, long-term thinking. It just gets weaker. You are chemically, physically predisposed to ignore your stop loss or chase a move out of FOMO.
So the goal isn't to be a robot who feels nothing. I mean, that's impossible.
Impossible. The goal is what we call emotional neutrality.
Which means
It just means recognizing the signal fast. Okay, I am feeling fear right now, or I am feeling greedy. And then you stop that feeling from getting to the execution stage. You create a space between the impulse and the click.
But how do you create that space when the market's moving and every second feels crucial?
The sources recommend a really simple technique. It's a command, either verbal or just in your head. You just say, I feel the emotion, but I do not follow it.
I feel it, but I don't follow it.
By saying it, by making it explicit, you're reinforcing the logical part of your brain over the emotional part. That little mental buffer, that's your greatest defense against a hijack.
And that pause, that buffer, is essential when we get to the next big trap, which is overthinking.
Analysis paralysis, yeah. It's when you need just one more confirmation, just one more indicator. You start questioning a strategy that you've already tested, that you already know works.
Right, and you're not executing, you're just looking for flaws that aren't even there. And that internal dialogue of doubt, it's just crippling. You're thinking, well, what if the news changes things? Or maybe I should wait for the hourly close, even though my 15-minute setup is perfect.
And what happens? You hesitate, you miss the perfect setup, and then you feel frustrated. And what does frustration lead to?
An impulsive revenge trade to try and catch up. It's a terrible cycle.
It is. And the key insight from the research on this is to know the difference between real analysis and just fear.
How do you tell them apart?
You have to ask yourself, am I finding a genuine fault in my written down defined strategy rules, or am I just scared of being wrong? If the doubt isn't based on your testable rules, if it's just this vague anxiety, it's just emotion. It's overthinking.
So you stop generating doubts that are outside the scope of your actual plan. And this is where that line between confidence and overconfidence gets really important.
So important. Real confidence is calm. It's rule-bound. It's built slowly through testing and good risk management. It's sustainable.
And overconfidence.
Overconfidence is loud. It's irrational. It shows up suddenly, usually after just one or two lucky wins, and it tells you to break your rules.
It's the voice that says, I'm on a roll, I don't need a stop loss on this one.
Or I can double my position size, just this once.
Yeah, that's the one. True confidence, the kind that lasts, comes from discipline, not from winning.
So you need to internalize that.
Yes, your anchor needs to be, my confidence comes from my discipline, not my results. Or, I trust my strategy because I put in the work and tested it.
And that mental prep is absolutely critical for navigating, I think, the most volatile emotional territory in trading. Streaks, both winning and losing. Yeah, so let's start with the losing streak. They're just psychologically heavy. After you take a couple of losses, your brain becomes hypersensitive to that pain, and it just amplifies all your doubts. You question the strategy, your own skill, everything.
And then comes the most dangerous reaction of all, revenge trading.
Right. Entering a trade based on one thing and one thing only. The emotional need to make your money back immediately.
And that's a total failure of process.
It's the definition of it. It violates every rule you have about risk and sizing. And it almost always leads to bigger losses. It turns a small, manageable drawdown into a catastrophe.
So how do you break that cycle?
You have to make a fundamental shift in your goal. During a losing streak, your goal is no longer financial recovery. It is process consistency.
That's a huge psychological reset. So you're saying the only way to stop the bleeding is to go back to following the plan perfectly, no matter how much it hurts emotionally.
That's it. The internal command has to be, my goal is consistency, not recovery. And I do not chase losses. I respect my plan.
Okay, but if losing streaks are painful, the sources say winning streaks are, what, the hidden killer?
They are arguably more dangerous.
Now that's a paradox. Why is a winning streak more dangerous than a losing one?
Because winning brings euphoria. It brings this feeling of being invincible. And it weakens your discipline, but it does it stealthily.
You feel untouchable.
Exactly. And that leads to taking on more risk, upping your lot sizes without a good reason, maybe ignoring your stop loss because, hey, the market always goes my way.
And the fall is bigger from a higher place.
The research is so clear on this. Many traders blow up their accounts during a winning streak, not a losing one. That feeling of euphoria encourages them to take one catastrophic risk that breaks their entire plan.
Wow. So you have to enforce discipline most when you feel like you need it least.
That's the challenge. And one great technique for this, for more advanced traders, is what the sources call quantified discipline drift prevention.
Okay, what's that?
After, say, 2 or 3 winning trades in a row, you immediately deliberately reduce your position size on the next trade by maybe 10 or 20%.
So you're leaning against the good feelings.
You're actively forcing yourself back into a neutral, low-risk mindset. You're not letting the positive results dictate your risk.
You're treating wins and losses equally.
That is the absolute definition of emotional neutrality. You can't let a dopamine hit change your risk management.
So your anchors for that have to be just as strong.
Yeah. A win does not give me special privileges, or a loss does not invalidate my entire strategy.
Okay. Let's bring all this home for you, the listener. We've gone through a lot. Impatience, trading boredom, the actual chemistry of fear, overthinking, and these paradoxical dangers of streaks.
We can really synthesize all of this into a practical, real-time checklist, a cognitive pattern interrupt you use right before you click the button.
What's on the list?
It's a few quick questions. First, am I strictly following my defined entry rules?
Yeah.
Second, am I trading out of boredom or FOMO or just anticipation?
Okay.
Next, is my hesitation based on my strategy or is it just fear? And finally, am I increasing my risk to recover losses or because the plan actually calls for it?
And if the answer to any of those points toward emotion, impatience, fear, greed, revenge, the instruction is always the same.
Always use the pause command.
Jump away.
Step away from the screen, take one deliberate breath, and reevaluate if your decision is rational or if it's reactive. That single action is so often the difference between keeping your capital and blowing your account.
Because successful trading needs that calm judgment for the analysis.
And relentless discipline for the action.
Putting those two together correctly, that's it. That's the whole game.
It's the single most defining factor for long-term survival in these markets.
And the central message, really, from all our sources, is that the quality of your decisions built up methodically over hundreds of trades is so much more valuable than the outcome of any one trade.
Absolutely.
Which leaves us with a final provocative thought for you to consider. If success really just depends on executing a proven strategy with discipline, then how much of your effort should actually be dedicated to analysis and testing before the market even opens? So that when you finally sit down at the screen, your only remaining job is the simple, dispassionate execution of your rules. That commitment right there is what determines your neutrality.
Welcome back to the deep dive. If you spend any time looking at trading, you hear the same thing over and over. 90% of success is psychology. But then you see most traders still chasing that one perfect indicator, that magic signal. So today, we're going to put all the technicals aside. We're doing a deep dive into the material that really confirms it. Trading is all about mastering your mind. We're going to focus on the big 3 psychological forces: fear, confidence, and identity.
And our mission here, for you, is to give you a real shortcut. We want to get to the heart of why traders make those lightning-fast emotional mistakes that they know they shouldn't. And more importantly, how you can spot the really subtle hidden signs of fear before you hit that button. This isn't just a lesson in finance. It's really a manual for making good decisions under very high pressure.
Yeah, and the insight that really jumped out at me from the sources was the sheer depth of the problem. It's not as simple as just being afraid of losing money. The fear that traders feel, it's multi-layered. There's the fear of the financial pain, of course, but also the fear of being wrong, the fear of failure. And this is the one that gets me, the fear of success. That one just sounds so contradictory, doesn't it?
It does, but they are all very real psychological hurdles. And if you want any kind of sustainable success, you have to get almost anatomical with fear.
Yeah.
You have to understand the physical mechanics behind it, because that's where the discipline breaks down first.
Okay, let's unpack that. The physical reality.
Yeah.
Because I know that feeling. I'm at my screen, a trade moves against me really fast, and there's that sudden tightness. Fear isn't just a thought in your head. It's a full body response. It changes your breathing, your heartbeat, and maybe most importantly, how you're even seeing the chart in front of you.
And that speed is the real enemy. That whole response is run by the ancient part of our brain, the amygdala, the emotional center. The second it senses what it thinks is risk, it just bypasses your rational brain entirely. It sends one simple message: prepare for danger.
And that message, that prepare for danger, that shows up as the stuff we all recognize, right? Adrenaline, heart racing, shoulders and jaw get tight, breathing gets shallow, and your mind just starts imagining the worst case scenario.
And that is the neurological reason for impulsive trading. It all happens in milliseconds. So your internal programming completely overrides your well thought out trading plan. You see a quick spike down, the physical feeling kicks in, and before your rational mind can say, wait, hold on, this is just volatility, your hand has already clicked. Close trade. Usually at the absolute worst possible moment, the automatic reaction is just faster than your discipline.
That makes total sense for those panic moves. But what about when it's not a full-blown panic? The sources talk about these hidden behaviors. Fear can be sabotaging you even when you think you feel totally calm.
Absolutely. And hidden fear is so dangerous because it disguises itself as being prudent or cautious. You'll see it when a trader has a textbook perfect setup. Everything lines up and they hesitate. They think, oh, what if this is the one that fails? And then they watch the move happen without them. That's the fear of execution.
Or the opposite. Closing a trade way too early for a tiny profit. Taking, $50 when the system was targeting 200. I think we've all felt that one. It's that anxiety of watching your profit shrink, even just for a moment.
That's the fear of giving back profit. You prioritize the emotional relief of a small, sure win over the logic of your system. Another one is moving your stop loss further away. Basically just hoping the market will come back and save you. That's the fear of being wrong, but it feels like you're being optimistic. And of course, the one we mentioned earlier, the fear of success.
Okay, let's stay on that for a second. Why on earth would winning be scary?
Because success creates expectation. You hit a winning streak, and suddenly the pressure is on. You're afraid of the attention. You're afraid of letting yourself down. And you're especially afraid of how it'll look if you follow up that big win with a huge loss. And that often leads to self-sabotage. You might take a crazy risk just to, get it over with, or you just stop trading. Because if you don't trade, you can't lose that winning status. Your new identity becomes a burden.
So the body is running the show. The first step then has to be breaking that automatic cycle. How does that simple awareness exercise actually help? I notice my breathing. It sounds almost too simple.
It sounds simple, but it is profoundly effective. The moment you use one of those anchors, I notice my shoulders are tight. I notice my breathing is shallow. You are forcing your rational brain to come back online. You're breaking the loop. You're pausing the amygdala's immediate danger signal. Look, awareness isn't control, but it's the absolute first step towards control. You can't release tension you don't know is there.
Right. Understanding the physical reaction is step one. So now that we see how fear works, let's talk about building confidence, which leads us to the foundation of real trading success, procedural trust and identity.
This is such a critical distinction. Real lasting confidence is not built from winning trades. Winning trades only give you a temporary excitement, a buzz. If your confidence depends on your last trade being a winner, then the very next loss is going to completely shatter it. True confidence, the kind that weathers the storms, comes from knowing your process, following your rules, and trusting your analysis, even when you're in a drawdown.
That's a huge challenge to how people normally think. Most people assume if they could just win big, they'd suddenly feel like a master. But you're saying a lucky streak doesn't build confidence. Only a predictable, repeatable process does.
Yeah.
Like a pilot. They trust their pre-flight checklist no matter how easy the last landing was.
Exactly. It comes from familiarity, from the psychological safety of knowing you have a clear, tested strategy, and a massive part of building that is separating your own identity, your self-worth from your trade results.
The material really hammers this point. A loss isn't a reflection of how smart you are or your value as a person. It's the cost of doing business. It's a normal part of the system.
Yes, and this is the trap. So many traders internalize the loss. They think, I am a bad trader. Instead of thinking, That was a valid risk within my plan, and it resulted in a standard loss. Once you accept that a loss doesn't actually change who you are, you build this incredible psychological strength, and your next decision becomes stable, not driven by revenge.
Which flows right into this idea of having a market identity. If you haven't separated yourself from the P&L, you probably don't have a clear framework for how you even see the market. So what happens to traders who just don't have that foundation?
Instability. It's
Yeah.
guaranteed.
Yeah.
They become what you call system hoppers. One day they're scalping with one indicator. The next they're trying to swing trade with a completely different theory. They're always changing things, chasing the next holy grail. And that constant shifting creates enormous stress because you never develop that familiarity we talked about. You never build real confidence.
Okay, so to build that stability, the material breaks down this market identity into 3 parts. 3 things you need to define for yourself.
Precisely. First is strategy identity. What specific system, what rules are you following? Be exact. Second, time frame identity. Are you a scalper, a day trader, a swing trader? You have to commit to a pace. And third, risk identity. How much money in actual dollars feels emotionally safe for you to risk on one trade? Truly safe.
I can see immediately where the stress comes from. It's the mismatch. Let's say I tell myself, I'm a calm, patient swing trader, but I spend all day staring at the 1-minute chart, watching every tick. My identity is mixed. I'm a scalper pretending to be a swing trader, and that conflict, that's where the emotional pressure cooker starts to boil over.
That gap between your aspiration and your action is the source of the anxiety. It forces you to ask the question, what kind of trader are you truly when you're under pressure? Not who you want to be. And the solution is honest self-assessment, not just trying to force yourself to be something you're not.
Okay, moving on to part 3. Mastering that inner voice, which in a lot of ways is the only indicator that really matters. The sources are clear on this. Your internal dialogue, what you're saying to yourself during a trade, shapes your emotions more than anything on the chart.
Think of it as a feedback loop. If your inner voice is all negative dialogue, what if this loses? Or this is going to my stop, isn't it? That commentary creates anxiety. It physically tightens your muscles, and it feeds that fear response in the amygdala we were just talking about.
So the goal is to replace that with a stable, positive dialogue. Not like toxic positivity, right?
Yeah.
But factual, procedural self-talk.
Exactly. It must be process-oriented. I follow the rules of my system. My risk is controlled, and it's acceptable to me. I accept whatever the outcome is. That stable inner voice is your anchor for discipline. It keeps your decisions focused on your process, not the random outcome.
And this is where that inner voice can lead you into immediate danger. The trap of emotional momentum. This isn't just one bad decision. It's a psychological chain reaction that spirals completely out of control. It's how people blow up their accounts in an afternoon.
And the sequence is so tragically common because each small emotion feeds the next one. It often starts with a little fear, which leads to hesitation. Then you miss the trade, and that hesitation turns into regret. Regret causes frustration. Why didn't I just take it? And that frustration can trigger an impulsive trade to make it back. That trade almost always leads to a bigger loss. That loss sparks real anger, and the anger leads to full-on revenge trading.
It's terrifying because each step feels justified in the moment. So if you feel yourself starting down that emotional slope, that first spark of anger or regret, how do you stop it? How do you interrupt that momentum?
You have to interrupt it immediately. The second you feel that first emotion, you have to pull the emergency brake, and it's a 4-step method. Pause. Breathe. Evaluate. Decide. Pause forces a break in the chain. Breathe resets the physical tension. Evaluate means you check the situation against your actual rules. And only then do you decide what to do next, which might just be closing your laptop for the day.
Which brings us right back to body awareness. The body really does speak first. So I'm feeling that momentum building. What are the physical alarm bells I should be listening for?
Tension is always the key signal. A dry mouth, cold hands, constantly fidgeting, shoulders up by your ears. If you notice these signs, your body is telling you that you are in fight or flight mode and your decisions are already compromised. So physically relaxing your body, sitting up straight, consciously relaxing your jaw, taking a slow exhale that literally downsheaths your nervous system and makes clear thinking possible again.
That grounding is so critical. Which brings us to our final part. Reframing risk and acceptance, and really dealing with the hard truth that you simply cannot control the market.
That illusion of control is the fundamental source of anxiety for so many traders. They try to control the outcome of every single trade, but you can't. The market is inherently unpredictable. It's chaotic.
So you have to focus only on the things you can control. Your decisions, your risk, your patience, your discipline. Trying to force the market to do what you want it to do only creates this crippling anxiety.
And we also have to deal with the emotional weight of money itself. Money is rarely just numbers on a screen. For most people, it represents security or status or freedom. So when you risk money that is emotionally heavy, you aren't just risking capital, you're risking what that capital represents. If the amount you're risking feels like a threat to your survival or your status, well, every single trade is going to be an emotional roller coaster.
So the answer isn't to somehow become detached from money, because that's impossible. It's about finding your emotional tolerance level.
That's it, exactly. The key is to adjust your risk, your position size, until the maximum potential loss is an amount you can lose without feeling that deep emotional pain or panic. If losing X dollars makes you anxious or angry or unable to sleep, then X is too high for you, period. You have to reduce your size until calmness is your baseline state, as the material says. Calmness is the foundation of discipline. You can't be disciplined if you're rattled.
That is probably the most practical advice there is. So to summarize this whole deep dive, fear is a physical reaction, and you have to manage it with physical awareness. Real confidence is purely procedural. It comes from following your rules, trusting your system, not from a few lucky wins. And stability requires a really clear market identity. Know your strategy, your time frame, and your true risk tolerance. Ultimately, it seems success demands taking measured, strategic risks, not trying to avoid emotion altogether.
And if you connect all that, confidence really just means choosing to act on your system, even when fear is whispering in your ear. So your task now is to reflect on the specific internal rules, your stability anchors, that you need to build into your daily routine. You have to commit to the mindset that you will trust your system more than your fears. Internalize those anchors. I release emotional pressure, and I accept losing as a predefined, necessary part of my system. Build those simple truths into your identity, and the stability you're looking for will follow. Welcome to the deep dive. Today, we're doing something a little different. We are going to intentionally ignore the charts.
Yeah, we're putting the indicators and the candlesticks aside for a bit.
And we're turning the binoculars inward. For so long, the conversation around trading success has been all technical, but the real pillars of consistency, they're almost all psychological.
That is the absolute core of what we're looking at today. Our mission here is to give you a kind of shortcut.
A framework.
Exactly. A framework for understanding the mental game that separates disciplined action from, those emotional mistakes we all make. We're going to try to transform what you might think is a discipline problem into what's actually a clarity problem. We've got a great roadmap covering everything from emotional triggers to achieving what's called emotional neutrality.
Okay, let's start right there. With discipline. Because when most of us hear that word, we think of, willpower, gritting your teeth.
Forcing yourself. It sounds exhausting.
It does. But the material we've been digging into challenges that completely. It argues that real discipline isn't about pressure at all. It's about clarity.
Think of it this way. If your rules are razor sharp, so clearly defined, there's zero room for interpretation, then discipline just happens. It's almost automatic. But if your rules are vague, that's when you start that internal war with yourself.
I think we've all been there with the classic vague rule. The trader who says, I'll only trade good setups.
Oh, that's the one. It's totally meaningless under pressure.
Because what good means changes the second a big candle appears, or you feel that fear of missing out.
Precisely. It's a subjective mess. Now contrast that with something measurable, something like the market structure must be confirmed on the 15-minute. My entry requires a 3-minute candle close above the prior high, and my stop goes exactly 5 ticks below the last low.
See, when you say it like that, it's a checklist. The setup either meets the criteria or it doesn't. You're taking the emotion out of it.
The system decides.
But let me push back on that a little. What about the trader who has those super specific rules written down, but they still break them? Isn't that a discipline problem?
That is a fantastic question. Because the sources suggest that even then, the clarity is incomplete. The entry rules might be clear, but the process around them isn't.
Okay.
A truly disciplined trader's plan doesn't just say follow the rules. It says, I will check my risk before I touch the trade button, and maybe if I break a rule, I log off for 30 minutes. No exceptions.
So clarity has to cover the whole The whole behavioral ecosystem, not just the entry.
Exactly. When you define everything, the stress just drops. You get calmer, more confident. Any ambiguity you leave in your process, your emotional mind is going to fill that void with fear and doubt.
So a discipline problem is almost always a clarity problem. I like that.
It's a huge shift in perspective.
So if clarity is our foundation, the next layer has to be awareness. And this is where we get into what the sources call market triggers.
Right. And these are they're those specific moments you see on a chart that just set off an immediate emotional reaction.
And they're different for everyone. They're like these invisible tripwires.
Totally invisible until you actually identify them. And the list of common ones is interesting because they're all just normal market behavior.
Like what? Give us some examples.
Okay, so a sudden price spike. Or the opposite, a long, boring period of consolidation. Gaps, false breakouts, a single huge candle.
Or even just a deep pullback in a trend that you thought was solid.
All of it. For one person, a big green candle triggers excitement, FOMO. For someone else who got burned before, that same candle triggers pure fear.
It's their emotional landscape.
And since you can't get rid of market volatility, the goal becomes what the sources call emotional engineering.
Emotional engineering, I love that. So how's that work in practice? How do you engineer your response?
Let's say you know that fast, volatile markets make your anxiety spike and you make bad decisions. You have a couple of engineering options. One, you could just avoid trading during major news events. You remove the trigger from your environment entirely. Or two, if you feel you have to trade, you engineer your position size way, way down.
By cutting the size, you lower the emotional threat.
You lower the financial risk, which directly lowers the emotional stakes. The anxiety might still pop up, but you've engineered the situation so it can't cause a catastrophic mistake.
That makes perfect sense. And this leads right into building your own emotional profile. This is a critical tool.
It is. This is basically your personal map, a list of the emotions you feel: anxiety, impatience, fear, and the specific market triggers that bring them out.
So how do you start building that? What do you ask yourself?
You have to get really honest. Ask, what am I feeling before I enter a trade? What's going on in my body during a trade? And most importantly, what patterns of mistakes do I keep making because of these feelings?
Once you see that connection between the trigger on the chart and the feeling inside, that's where you start to gain some control.
That's the first step.
Which brings us to, I guess, the next level of mastery here: emotional neutrality.
Yes. And this is so often misunderstood. It's not about being a robot.
Right. It's not about feeling nothing.
No. You might still feel your heart race a little or your palms get sweaty, but those feelings stop influencing your decisions. Your actions stay stable.
And that stability comes from taking your ego out of the trade.
Exactly. You replace the ego talk. Instead of, I need this trade to win or I can't lose again, you substitute it with a cold, logical checklist.
Things like, did I follow my entry rules?
Is my risk correct? What's my max loss on this position? The difference between trading to prove something and trading to execute a plan.
That's a huge distinction.
And it takes practice. You literally have to rehearse it. Mentally repeat things like, I remain calm before entering, I stay neutral during the trade, I accept the outcome without emotion.
So if neutrality is the goal, what's the anchor that keeps us there?
The sources are really clear on this. It's routine, a powerful, defined pre-market routine. It creates psychological safety.
It reduces the unpredictable variables.
Totally. It reduces the emotional load. If you check the news every morning at 7 a.m., you aren't surprised by volatility later. If you review your rules before you even open the platform, you're grounding yourself in process, not profit.
You know, that first step of the day is so important. Waking up and immediately checking your charts just floods your brain with pressure.
It ruins the whole mindset. A good routine has to start with a calm step first. Some deep breathing, a quick rule review, something to set a neutral tone.
Let's shift gears a bit and talk about two of the biggest enemies of consistency: impulse and boredom.
The big two.
Impulses, it's acting before thinking. It's driven by this sudden, overwhelming sense of urgency. The thought is always, I have to get in on this right now.
It's a neurological rush. It literally bypasses the rational part of your brain. So you need an immediate countermeasure.
A circuit breaker.
A circuit breaker, exactly. And it's deceptively simple. The second you feel that urge, you stop. You literally just count in your head, 1, 2, 3. And only then you ask the question, does this setup match my written rules? That 3-second pause is usually just enough for the impulse to fade and for your logical brain to get back online.
It's amazing how powerful a simple pause can be. Okay, now for the other one, the quiet killer. Boredom trading.
Ah, this one is so insidious. Because proper trading should be structured and, let's be honest, a little bit boring. It's not supposed to be exciting.
Right. Boredom is that restlessness you feel when the market is slow and you just want some action.
And the internal dialogue is so dangerous. It's, I just want something to happen, or I'll just take a tiny trade for fun.
And when you do that, you're not trading the market anymore.
You're trading your boredom. And the market only pays for quality, never for activity. So you have to counter that with self-talk, like, I wait for quality setups, I focus on my process, not on excitement.
This all seems to connect back to creating some sort of distance.
Psychological distance. It's an advanced technique to stop yourself from getting overwhelmed. The sources point to 3 types.
Okay, what are they?
The first is time distance. That's our 3-second rule, just creating a pause. The second is physical distance.
You mean like literally leaning back from the screen?
Yes. Lean back, stand up, shake your hands out. Break that intense physical focus that amplifies the emotion.
And the third?
Cognitive distance.
Yeah.
This is where you step back mentally and ask objective questions instead of just reacting. Is this feeling based on my strategy, or is it just fear? Or what would a completely neutral trader do right now?
You're forcing yourself to be an observer of your own emotions. And I guess what you say to yourself in that moment, that's everything.
It is. Your self-talk shapes your identity as a trader. If you're always telling yourself, I always mess this up, you'll find a way to make that true.
You have to replace it.
You have to. With things like, I follow my plan no matter the outcome, or I learn from every trade, win or lose. You are choosing your identity. I choose clarity. I choose patience.
And it's important to remember this isn't, a straight line. The sources talk about this recurring emotional cycle that traps people.
Yes, it goes. Confidence, which leads to overconfidence, which leads to a mistake.
Then a loss, then shock, then fear and doubt, and your discipline crumbles.
The key is just recognizing where you are in that cycle. If you feel euphoric and overconfident, that's your signal to proactively reduce your risk. If you feel intense fear, that's your signal to step away and breathe.
So to make this all practical, the sources lay out 5 daily mind training drills, almost like a mental workout.
That's a perfect way to describe it. 1, deep breathing practice. 2, a full review of your rules. 3, visualization, seeing yourself follow your rules perfectly.
4 is an emotional awareness scan, just checking in with how you feel. And 5 is post-trade journaling.
Doing those things consistently is how you build that unstoppable identity. You become calm, patient, disciplined, and consistent because you practice being those things every single day.
Right.
Your identity shapes your behavior, and your behavior shapes your results.
So we've gone from redefining discipline as clarity to mapping your emotional triggers to finding neutrality through routine and finally to breaking those traps of impulse and boredom. It really seems like psychological mastery isn't some gift you're born with.
No, not at all. It's a skill. It's a deliberate, structured pursuit of consistency.
The sources are pretty clear. This requires constant, dedicated practice. So if the identity you're trying to build is consistent, that leaves a final, maybe provocative question for you, our listener.
It does. The question is, what single, non-negotiable step from everything we've talked about will you commit to making a daily repetition to anchor that new identity?
Is it going to be that 3-second impulse control pause?
Or maybe it's the 2-minute deep breathing and rule review drill before you even start your day. The key is to choose one anchor and just start that repetition. Start it today.
Thank you for joining us on the Deep Dive. We hope this roadmap helps you find clarity and consistency on your trading journey. Welcome back to the Deep Dive. Today we are tackling something that I think fundamentally changes how you look at discipline and consistency, especially in high-stakes fields like trading. We've got a great stack of sources here on risk behavior, and our mission today is pretty simple. We want to stop treating risk as just a number on a spreadsheet.
Yeah.
And start treating it as what it really is, a psychological weight.
That is the crucial shift.
Yeah.
It really is. It's what separates the people who make a career out of this from those who, just struggle for years.
Right.
Most people get stuck on risk management, the cold math, the 1% rule, all
The
that.
formulas.
Exactly. But these sources show that what really determines if you'll stick to your plan is risk psychology. It's the emotional pressure. That's what really matters.
And here's the core argument, and it's a bit counterintuitive. It's that your risk size, the amount of money you put on the line, actually controls your emotions more than your strategy does.
Far more. It's not even close.
Think about that. You could have a brilliant, back-tested strategy, but it becomes totally useless if your risk size pushes you past your comfort zone.
But then you flip that around.
Right.
Even a pretty average strategy can feel remarkably manageable, easy even, if the risk you're taking is tiny.
And that explains everything. It's why two people can look at the same chart, use the same system, and one of them is calm and the other is a complete mess.
It all comes down to the weight.
Okay, so let's unpack this idea of emotional weight, because mathematically, a 2% or 3% risk is standard. It's accepted. So why do so many traders assume they can handle it on paper, but then just freeze or panic the second a trade goes against them? What's actually amplifying that loss?
It's the difference between risk on paper and risk in the market. We call it the amplification effect.
Okay.
When you're watching real money, your own money, fluctuate, your emotions just magnify every little tick.
Wow.
This isn't theoretical. It's visceral.
You can feel it.
You can absolutely feel it. One of the sources puts it perfectly. A 3% loss on your chart, which is statistically fine, can feel like 10% in your chest, 20% in your head, and like a 30% emotional hit.
Wow. That is a huge gap between the 3% reality and the 30% feeling.
It is.
So what's filling that gap? It's these destructive thoughts, right? They're not based on the market. They're based on the pressure.
Exactly. It's the what ifs.
What if I lose again?
What if I can't recover from this?
Or maybe I have no idea what I'm doing.
Right. And those thoughts aren't logic. They're just the mind screaming because it's under too much pressure. That feeling, that overwhelm, that is the definition of oversized risk.
And we should be clear here. Oversized risk isn't just about taking some massive position.
Not at all. It's any risk level, any at all, that is bigger than your personal emotional capacity.
And that's unique to every single person.
Completely unique. And if your risk crosses that line, your discipline, your focus, your entire plan, it will break. It's inevitable. That's why psychology has to come before the math.
And when you cross that threshold, you get all the classic behaviors we hear about.
All of them.
Hesitating on a good setup, closing a winning trade way too early because you can't stand to see it pull back even a little bit.
Or the worst one, holding a loser, just hoping it comes back.
Right. And these aren't signs that you're just an undisciplined person. They are symptoms.
They are purely symptoms of choosing a lot size that is too heavy for your mind to carry. That's it.
So let's define that threshold. You called it emotional capacity.
Yes. It's literally the maximum amount of psychological pressure your mind can handle before the logical part gets, overwhelmed.
And everyone has a different limit.
Everyone. Think of it like a scale. For one person, losing $5 is nothing. Totally neutral. But losing, say, $80 makes them scared. And maybe $150 sends them into a full panic.
That panic state is where the bad decisions happen.
That's where you blow up accounts.
So the goal isn't to become some fearless robot who can risk thousands without flinching.
Not at all. The goal is much simpler. It's just to size your risk so you stay in what we call the balance zone.
That sweet spot where you feel calm and focused.
Right. Where you can actually think clearly. Because if the risk is too small, you get bored. And boredom is dangerous. It leads to forcing bad trades.
And if it's too big, you're overwhelmed. Fight or flight kicks in.
Exactly. You just want to stay in that neutral balance space.
Okay, so how do you find your true limit? Not the one you pretend you can handle, but the real one.
There's a really powerful thought experiment for this.
Yeah.
So for everyone listening, try this right now. Imagine a losing streak.
A realistic one.
Yeah, let's say 3 trades in a row. They all hit your stop loss. Not because you did anything wrong, just market randomness.
It happens.
It happens.
Yeah.
Now ask yourself with brutal honesty, how much total money can I lose across those 3 trades before I feel that sense of panic?
That urge to just shut everything down, or even worse, revenge trade.
Exactly, that panic point. Your body's instant gut reaction to that number, that is your real threshold, not the number you read in a book.
So if you imagine losing, say, $300 total, and your stomach just drops.
Then your limit is not $100 per trade. Your body's telling you that's too much.
And the takeaway from that is so direct. If your honest answer is, I can only handle losing $30 total before I lose my cool, then you should never risk more than $10 a trade.
Period.
Yeah.
It's that simple. You have to respect the number you feel, not the number you think you're supposed to be able to handle.
This is where it gets really interesting for me. How can the lot size alone completely change the same person's behavior?
It's fascinating, isn't it?
Let's do another thought experiment. Take one trader. When they use a small lot size, what do? They wait calmly, they follow the plan, they're patient.
But then you take that same person, same strategy, same day, and just increase the lot size to a point that's just a little too big for them. What happens?
Oh, everything changes. Every tick of the price scares them. They're staring at the screen. They can't look away.
They act impulsively. They move their stop loss. They panic on a normal pullback.
So when traders complain, my psychology is bad or I have no discipline,
The problem is almost always simply, the lot size is just too heavy. That's the diagnosis.
and if you reduce the risk.
The discipline magically comes back because it was never gone. It was just buried under too much pressure.
So if it's not just the lot size, what are the other hidden things that turn a small dollar loss into this huge psychological blow?
That brings us to the formula of emotional pressure. It shows you the hidden variables.
Okay, what is it?
It's emotional pressure equals your lot size, plus the personal meaning of that money, plus your self-expectations, plus your general fear of loss.
Wow. Let's break that down because those last parts are killers. The personal meaning of money.
Huge.
Yeah.
If the money you're risking is, rent money or money you can't afford to lose, the pressure just skyrockets. A $50 risk might as well be $5,000 emotionally.
And what about self-expectations?
That's your ego. If you go into a trade thinking, I have to win this, or my analysis is perfect, you're not just risking money anymore.
You're risking your identity, your self-worth.
And you cannot think logically under that kind of pressure. The only real solution is to reduce the pressure at the source, the risk size.
We also have to touch on the money illusion.
Yes.
For a trader, a $10 loss doesn't just feel like $10. It feels like I failed or my analysis was wrong.
I wasted my time.
Right. The brain just multiplies the emotional meaning. So that $10 loss feels like a $50 emotional hit.
Which is why you have to find your comfort loss number.
What's that?
It's the amount you can lose without it triggering those deep emotional reactions.
Yeah.
And here's a second test for everyone listening.
Okay.
Ask yourself this. If I instantly lost this amount of money right now, would I still feel calm enough to immediately take the next valid trade?
If the answer is no, the amount is too high.
It's too high. That number, your unique comfort loss number, is the boundary. Trading above it guarantees chaos. Trading within it builds psychological strength.
Let's connect this to what's actually happening in your body, the physiology of it.
Yeah, because the physical toll is very real. When your risk is too big, your body goes into a genuine stress state. Your breathing gets shallow, you get tunnel vision, your heart rate spikes.
Fight or flight.
It's classic fight or flight. And what's fascinating is that this stress response chemically shuts down your logical brain, the prefrontal cortex, the part you need for planning and good decisions.
So the emotional part, the amygdala, just takes over.
It takes the wheel. And that's when you overreact, you panic, you exit a perfectly good trade.
It's incredible that just a small change in risk size can literally turn off the part of your brain you need to trade well.
And you contrast that with a low-risk state. Your nervous system is calm, your breathing is slow, your thoughts are clear. The equation is just unavoidable.
Small risk equals strong psychology.
Large risk equals emotional chaos.
And you mentioned that fear is the obvious danger, but that excitement is just as bad.
It is equally dangerous. Physiologically, excitement is often just fear in a different costume. It's the same adrenaline, the same dopamine.
So if a trade feels really exciting, like this is the big one.
The lot size is too big.
Yeah.
Almost certainly. A professional, healthy trade should feel neutral, calm, almost boring. Routine. The lack of an emotional spike is the actual goal.
So for anyone trying to figure out their safe lot size right now, you've got 3 questions they should ask. Not about their account balance, but about their body.
Exactly. First, does this lot size allow me to breathe normally during the trade?
Second.
Can I hold this trade through a normal pullback without panicking?
And third.
Can I lose with this size and still feel emotionally stable enough to analyze the next opportunity clearly?
And if the answer to any of those is no,
the size is too big. Period. End of story.
That brings us to a huge trap. Scaling up too fast.
Oh, it's a classic.
You have one good week, maybe one good month, and you think, okay, I'm ready. I can handle 3 times the size now.
But your emotional limits, they do not grow as fast as your account balance.
So what's the danger there?
It's psychological shock. Your mind has adapted to risking, say, $10, but now you're suddenly risking 50. That jump creates immediate fear, even on a winning trade, because your nervous system isn't ready.
So you need to adapt slowly.
Slowly. Stable, incremental growth. That's how you build psychological capacity. Trying to grow too fast almost always leads to a complete collapse of discipline.
So what's the big takeaway for everyone today? What does this all mean?
I think the key insight is that risk sizing isn't just some technical thing you do last. It is the absolute foundation of your entire emotional experience in the market.
If the risk is right for you personally, then even an average strategy can feel stable. You can execute it.
And that's why you always hear the same advice from successful traders, right? It sounds almost too simple.
Protect your capital, trade small, stay calm.
Exactly. Because calmness is the only path to consistency, and small size is what makes calmness possible.
So that's our deep dive. The core idea to remember is this. Discipline and psychology are not fixed traits you're born with. They are the direct consequences of the risk size you choose. If you change the size, you change your mind.
And here's a final thought to leave you with this week. A provocative question. If the emotional weight of your trades is causing you stress, how much time and energy are you wasting trying to fix your strategy?
Or your entries or your analysis.
The real solution might be as simple as just turning down the volume knob on your risk. Go find your comfort loss number and adjust immediately.
A practical challenge to end on. Thank you for joining us on this deep dive into risk psychology.
My pleasure.
We'll catch you next time. Welcome to the deep dive. Today, we're doing something a little different. We are going to intentionally ignore the charts.
Yeah, we're putting the indicators and the candlesticks aside for a bit.
And we're turning the binoculars inward. For so long, the conversation around trading success has been all technical, but the real pillars of consistency, they're almost all psychological.
That is the absolute core of what we're looking at today. Our mission here is to give you a kind of shortcut.
A framework.
Exactly. A framework for understanding the mental game that separates disciplined action from, those emotional mistakes we all make. We're going to try to transform what you might think is a discipline problem into what's actually a clarity problem. We've got a great roadmap covering everything from emotional triggers to achieving what's called emotional neutrality.
Okay, let's start right there. With discipline. Because when most of us hear that word, we think of, willpower, gritting your teeth.
Forcing yourself. It sounds exhausting.
It does. But the material we've been digging into challenges that completely. It argues that real discipline isn't about pressure at all. It's about clarity.
Think of it this way. If your rules are razor sharp, so clearly defined, there's zero room for interpretation, then discipline just happens. It's almost automatic. But if your rules are vague, that's when you start that internal war with yourself.
I think we've all been there with the classic vague rule. The trader who says, I'll only trade good setups.
Oh, that's the one. It's totally meaningless under pressure.
Because what good means changes the second a big candle appears, or you feel that fear of missing out.
Precisely. It's a subjective mess. Now contrast that with something measurable, something like the market structure must be confirmed on the 15-minute. My entry requires a 3-minute candle close above the prior high, and my stop goes exactly 5 ticks below the last low.
See, when you say it like that, it's a checklist. The setup either meets the criteria or it doesn't. You're taking the emotion out of it.
The system decides.
But let me push back on that a little. What about the trader who has those super specific rules written down, but they still break them? Isn't that a discipline problem?
That is a fantastic question. Because the sources suggest that even then, the clarity is incomplete. The entry rules might be clear, but the process around them isn't.
Okay.
A truly disciplined trader's plan doesn't just say follow the rules. It says, I will check my risk before I touch the trade button, and maybe if I break a rule, I log off for 30 minutes. No exceptions.
So clarity has to cover the whole behavioral ecosystem, not just the entry.
Exactly. When you define everything, the stress just drops. You get calmer, more confident. Any ambiguity you leave in your process, your emotional mind is going to fill that void with fear and doubt.
So a discipline problem is almost always a clarity problem. I like that.
It's a huge shift in perspective.
So if clarity is our foundation, the next layer has to be awareness. And this is where we get into what the sources call market triggers.
Right. And these are they're those specific moments you see on a chart that just set off an immediate emotional reaction.
And they're different for everyone. They're like these invisible tripwires.
Totally invisible until you actually identify them. And the list of common ones is interesting because they're all just normal market behavior.
Like what? Give us some examples.
Okay, so a sudden price spike. Or the opposite, a long, boring period of consolidation. Gaps, false breakouts, a single huge candle,
Or even just a deep pullback in a trend that you thought was solid.
all of it. For one person, a big green candle triggers excitement, FOMO. For someone else who got burned before, that same candle triggers pure fear.
It's their emotional landscape.
And since you can't get rid of market volatility, the goal becomes what the sources call emotional engineering.
Emotional engineering, I love that. So how's that work in practice? How do you engineer your response?
Let's say you know that fast, volatile markets make your anxiety spike and you make bad decisions. You have a couple of engineering options. One, you could just avoid trading during major news events. You remove the trigger from your environment entirely. Or two, if you feel you have to trade, you engineer your position size way, way down.
By cutting the size, you lower the emotional threat.
You lower the financial risk, which directly lowers the emotional stakes. The anxiety might still pop up, but you've engineered the situation so it can't cause a catastrophic mistake.
That makes perfect sense. And this leads right into building your own emotional profile. This is a critical tool.
It is. This is basically your personal map, a list of the emotions you feel: anxiety, impatience, fear, and the specific market triggers that bring them out.
So how do you start building that? What do you ask yourself?
You have to get really honest. Ask, what am I feeling before I enter a trade? What's going on in my body during a trade? And most importantly, what patterns of mistakes do I keep making because of these feelings?
Once you see that connection between the trigger on the chart and the feeling inside, that's where you start to gain some control.
That's the first step.
Which brings us to, I guess, the next level of mastery here: emotional neutrality.
Yes. And this is so often misunderstood. It's not about being a robot.
Right. It's not about feeling nothing.
No. You might still feel your heart race a little or your palms get sweaty, but those feelings stop influencing your decisions. Your actions stay stable.
And that stability comes from taking your ego out of the trade.
Exactly. You replace the ego talk. Instead of, I need this trade to win or I can't lose again, you substitute it with a cold, logical checklist.
Things like, did I follow my entry rules?
Is my risk correct? What's my max loss on this position? The difference between trading to prove something and trading to execute a plan.
That's a huge distinction.
And it takes practice. You literally have to rehearse it. Mentally repeat things like, I remain calm before entering, I stay neutral during the trade, I accept the outcome without emotion.
So if neutrality is the goal, what's the anchor that keeps us there?
The sources are really clear on this. It's routine, a powerful, defined pre-market routine. It creates psychological safety.
It reduces the unpredictable variables.
Totally. It reduces the emotional load. If you check the news every morning at 7 a.m., you aren't surprised by volatility later. If you review your rules before you even open the platform, you're grounding yourself in process, not profit.
You know, that first step of the day is so important. Waking up and immediately checking your charts just floods your brain with pressure.
It ruins the whole mindset. A good routine has to start with a calm step first. Some deep breathing, a quick rule review, something to set a neutral tone.
Let's shift gears a bit and talk about two of the biggest enemies of consistency: impulse and boredom.
The big two.
Impulses, it's acting before thinking. It's driven by this sudden, overwhelming sense of urgency. The thought is always, I have to get in on this right now.
It's a neurological rush. It literally bypasses the rational part of your brain. So you need an immediate countermeasure.
A circuit breaker.
A circuit breaker, exactly. And it's deceptively simple. The second you feel that urge, you stop. You literally just count in your head, 1, 2, 3. And only then you ask the question, does this setup match my written rules? That 3-second pause is usually just enough for the impulse to fade and for your logical brain to get back online.
It's amazing how powerful a simple pause can be. Okay, now for the other one, the quiet killer: boredom trading.
This one is so insidious. Because proper trading should be structured and, let's be honest, a little bit boring. It's not supposed to be exciting.
Right. Boredom is that restlessness you feel when the market is slow and you just want some action.
And the internal dialogue is so dangerous. It's, I just want something to happen, or I'll just take a tiny trade for fun.
And when you do that, you're not trading the market anymore.
You're trading your boredom. And the market only pays for quality, never for activity. So you have to counter that with self-talk, like, I wait for quality setups, I focus on my process, not on excitement.
This all seems to connect back to creating some sort of distance.
Psychological distance. It's an advanced technique to stop yourself from getting overwhelmed. The sources point to 3 types.
Okay, what are they?
The first is time distance. That's our 3-second rule, just creating a pause. The second is physical distance.
You mean like literally leaning back from the screen?
Yes. Lean back, stand up, shake your hands out. Break that intense physical focus that amplifies the emotion.
And the third?
Cognitive distance.
Yeah.
This is where you step back mentally and ask objective questions instead of just reacting. Is this feeling based on my strategy, or is it just fear? Or what would a completely neutral trader do right now?
You're forcing yourself to be an observer of your own emotions. And I guess what you say to yourself in that moment, that's everything.
It is. Your self-talk shapes your identity as a trader. If you're always telling yourself, I always mess this up, you'll find a way to make that true.
You have to replace it.
You have to. With things like, I follow my plan no matter the outcome, or I learn from every trade, win or lose. You are choosing your identity. I choose clarity. I choose patience.
And it's important to remember this isn't, a straight line. The sources talk about this recurring emotional cycle that traps people.
Yes, it goes. Confidence, which leads to overconfidence, which leads to a mistake.
Then a loss, then shock, then fear and doubt, and your discipline crumbles.
The key is just recognizing where you are in that cycle. If you feel euphoric and overconfident, that's your signal to proactively reduce your risk. If you feel intense fear, that's your signal to step away and breathe.
So to make this all practical, the sources lay out 5 daily mind training drills, almost like a mental workout.
That's a perfect way to describe it. 1, deep breathing practice. 2, a full review of your rules. 3, visualization, seeing yourself follow your rules perfectly.
4 is an emotional awareness scan, just checking in with how you feel. And 5 is post-trade journaling.
Doing those things consistently is how you build that unstoppable identity. You become calm, patient, disciplined, and consistent because you practice being those things every single day.
Right.
Your identity shapes your behavior, and your behavior shapes your results.
So we've gone from redefining discipline as clarity to mapping your emotional triggers to finding neutrality through routine and finally to breaking those traps of impulse and boredom. It really seems like psychological mastery isn't some gift you're born with.
No, not at all. It's a skill. It's a deliberate, structured pursuit of consistency.
The sources are pretty clear. This requires constant, dedicated practice. So if the identity you're trying to build is consistent, that leaves a final, maybe provocative question for you, our listener.
It does. The question is, what single, non-negotiable step from everything we've talked about will you commit to making a daily repetition to anchor that new identity?
Is it going to be that 3-second impulse control pause?
Or maybe it's the 2-minute deep breathing and rule review drill before you even start your day. The key is to choose one anchor and just start that repetition. Start it today.
Thank you for joining us on The Deep Dive. We hope this roadmap helps you find clarity and consistency on your trading journey.
Okay, so let's dive right in. We are talking about a topic that I think plagues every single person who deals with markets or really any high-stakes decision. It's that constant grinding battle against impatience.
It really is. And the sources you shared, they lay bare this really uncomfortable truth. Most of the time, failure in trading doesn't come from a bad strategy. It comes from an emotional inability to just wait.
It's the silent killer of consistency, isn't it? The chart is sitting there, totally objective.
Yeah.
But your mind is never neutral.
Never. And so our mission in this deep dive is to really unpack the 4 key psychological traps that cause you to override your own discipline and just act too soon.
Yeah, and the sources make it clear that impatience it's sneaky.
Yeah.
It starts as this, low-grade anxiety, just a feeling, but then it quickly becomes a destructive habit. We need to get past the basics here and really understand the roots of that anxiety.
Exactly. Why do we feel that compulsion to rush right when a perfect setup is just starting to form? This anxious energy, it seems to bubble up from 3 main places. The first one is the one everyone knows. Fear of missing out, yeah. But we have to see it for what it is. It's a very specific, almost primal fear that the market is about to make a huge move, and if you hesitate, you're left behind. For good.
And what makes that fear so powerful? Because it's not just a vague feeling. The second source you mentioned seems to be what really gives it teeth: emotional anchoring.
That's the one. It's all about your past experiences.
Right.
If you have ever missed a massive win, a move you spotted but you just didn't act on, your brain does not forget that pain.
Oh, not at all.
It's anchored vividly, and that memory drives the urgency now. It's whispering in your ear, don't let that happen again. This is the one you missed last time, so you have to get in.
Mm-hmm.
And that emotional pull just completely overpowers any rational strategy you might have.
And the third route is, well, it's just basic impulse control, right? The research suggests this isn't just about willpower. It's that fundamental human need for instant gratification.
It is. When your emotional brain demands action before your strategic brain can check the boxes, the plan is already lost.
So let's just walk through a classic example. You see a clear bullish pattern forming. Your strategy, the one you spent weeks testing, says you have to wait for, say, a volume confirmation or a close above resistance.
Right, but that anchored fear and that impulse are just screaming at you, it's going to break now. Get in before it's too late.
And the impatient trader jumps. They jump in based on a feeling, risking a false breakout. They're basically trading the anticipation of what might happen, not the confirmation of what is happening.
And that brings us to the really interesting part, the chemical reason why that bad behavior feels so good.
Yeah, this part is critical. Because if it's such a bad move, why is it so hard to stop?
Right.
Why does it feel so right in the moment?
Well, that's where things get neurological. The sources show there's an immediate chemical reward for entering a trade too early. The second you place that order,
Dopamine.
your brain floods with dopamine. It's an instant rush of excitement. But it's crucial to understand that is not confidence. It's just a chemical signal.
It's the dopamine reward circuit, right?
Yeah.
It's the same pathway that lights up when you, find food or win a simple game. It feels like you're being decisive.
Decisive, proactive, confident, all of it. But it's a cheap substitute for real conviction, which only comes from following a plan that you've tested and that you trust.
But, you do need some urgency in the market, don't you? How do you tell the difference between that actionable urgency and just fear-driven impulse?
That is a fantastic question. Actionable urgency comes from your criteria being met. The setup is confirmed, the signal is there, and now the window to act is closing. Impulsive urgency is all internal anxiety before the criteria are met. The trigger is a feeling, not a fact.
And the real danger, as the sources point out, is the reinforcement loop. If that impulsive early trade actually works, Eve just once.
Oh, it's terrible. The brain learns a profound, awful lesson. Early entry equals dopamine rush equals reward.
And that one memory of the rush is stronger than the 10 times it failed.
Much stronger. It's more emotionally compelling. This is why so many traders stay stuck in inconsistency. They're not chasing successful execution. They're addicted to the feeling of taking action.
So the big takeaway here is excitement is not a signal. It's a warning sign. You have to learn to recognize that rush for what it is before you click the button.
Exactly.
But okay, let's say you do. You manage to wait. You resist the rush. And that brings us right to the third huge psychological hurdle, the regret loop.
This is the price you sometimes pay for good discipline. You waited, you stuck to your rules, and then the market takes off without you, moving perfectly in the direction you predicted.
The emotional fallout is just crushing. It's this intense regret, frustration, maybe even panic. It's the worst kind of pain because you were right, but you didn't get the reward.
And your internal monologue is just brutal. I saw it come in. I should have just bent the rules this one time. I waited too long.
And that pain leads straight into what the sources call the reaction trap, or what a lot of traders call revenge trading.
Yes. You let the pain of that missed profit dictate your very next move. You jump in immediately, but now at a terrible price. Or you overcompensate and put on a bunch of low-quality trades just to make up for what you missed.
And you've just destroyed the very discipline you worked so hard to build. So the lesson here is something called cognitive reappraisal.
Exactly. It's a mental switch. Instead of letting your brain process that missed move as a failure, you have to actively reframe it. The second you see that price run without you, you have to pause, take a breath, and literally say to yourself, I followed my plan. My goal was discipline, and I succeeded. Missing one move isn't failure.
It's shifting the reward system from the outcome, the profit or loss, to the process, to just sticking to the plan. That's how you break that regret anchor.
It is, and it's a muscle. You have to train it. Because if you don't break that loop, the pain of regret becomes the single biggest driver of your impatience on the very next setup.
You become desperate not to feel that pain again.
And you jump in even earlier next time.
So if we put all this together, the roots of impatience, the dopamine, the regret, we're facing the ultimate psychological battle, right? It's just straight up patience versus FOMO.
That's the final boss. And we know exactly when FOMO is at its most powerful, when the price is moving fast, when a trade looks like it's about to break out, and crucially, When there's a lot of noise, social media, forums, headlines, everyone hyping a hot setup.
Yeah, and FOMO feels so logical in the moment. It disguises itself as urgency. It says, this is a real opportunity. If you wait, you are literally losing money. It's loud and incredibly compelling.
But patience is, it's the quiet teacher. It operates on a much slower frequency. It just reminds you the setup isn't ready, the rules aren't met, stick to the plan. Listening to FOMO leads to mistakes. Listening to the quiet teacher, that's what leads to mastery.
But if those emotional anchors are so strong and the dopamine is so reinforcing, is just telling yourself to breathe really enough, it seems a little too simple to fight powerful neurology.
That's a critical point. Awareness alone is not enough. You need sort of an external structure. And this is where the sources introduce a technique called if-then planning.
Okay, tell us more about that.
It's incredibly simple, but very effective. You create a detailed, pre-planned entry checklist. You write down the exact price, the exact volume, the exact time frame. The rule is absolute. If the market meets all three criteria, then I enter. If it only meets two, or if my brain is just screaming at me to get in, the answer is always no. It takes the decision out of that high-stress moment.
So you externalize the discipline. You're not relying on your emotional state in the moment. You're relying on the rational plan you made when you were calm.
Precisely. By forcing yourself to stick to the criteria, you are actively retraining your brain to connect the reward with following the plan, not just with taking action.
So to bring this all home, we've laid out these 4 interconnected pillars of psychological failure. Impatience, which is anchored in fear and impulse. Then there's the dopamine rush that rewards bad behavior.
Followed by the pain of regret when you're disciplined but miss a move. And it all culminates in that constant acute battle of FOMO versus your own plan.
But the good news here is that this is all trainable.
Absolutely. Patience isn't some trait you're born with, it's a mental muscle. And with practice, using tools like that cognitive reappraisal and rigid if-then planning, you build emotional stability. You turn the market from a source of anxiety into just a source of objective data.
We've established that awareness is that first crucial step, but it's the training that breaks the loop. The sources all point to things like mental drills, journaling your triggers, and so on. So here's a final thought for you to take away from this deep dive. What one small, tangible practice can you start today? Maybe it's just documenting the specific feeling. Is it the dopamine rush or the pain of regret? To start strengthening your own patience muscle before you take your next action. Think about that.
Welcome back to the deep dive. Last time, we really got into the thick of it, the psychology of making decisions under pressure.
We did. We talked about that battle between discipline and FOMO.
Right, the fear of missing out, that feeling, that absolute rush to jump in early, and then the pain of seeing a setup move without you. I think we all know that feeling. It's the enemy.
It is. And just understanding the problem.
Yeah.
You know, it isn't enough. I think if you're listening today, you're looking for a toolkit.
A practical toolkit, exactly.
So our mission for this deep dive is to move past the theory and get right into the how. Tradable solutions that make patience a default behavior, not some heroic effort you have to muster once in a while.
I like that. It's not about hoping to be patient. It's about actual daily mental training. You're trying to physically rewire your brain so you act deliberately instead of, just reacting on impulse.
Exactly. It's like strength training for your mind.
Yeah.
You don't get stronger by just wishing for it. It takes targeted resistance.
And in this case, the resistance is against that impulse to act now.
Right.
Okay, so let's start with something direct. A strategy that applies that resistance immediately. It's called delayed entry practice. And I'll tell you, this is going to feel uncomfortable at first.
Because it forces you to sit on your hands when everything in your body is screaming, go.
Yes.
Yeah, but hang on, let me challenge that for a second. If you've got a really fast-moving setup, setting a timer for, say, 5 or 10 minutes, doesn't that just guarantee you miss the entry entirely?
That is a great point, and it's the crucial tension we're training for. The goal isn't necessarily to never miss a trade. The goal is to break that immediate reaction loop.
Okay.
So the technique is simple. You see a setup that gives you that heart-pounding FOMO feeling, but instead of clicking, you set a timer. And let's not start with 10 minutes. That's too much. Let's say just 3 minutes.
3 minutes feels more doable.
Yeah.
And during those 180 seconds, you're not just waiting, are you?
No, you're actively observing.
Yeah.
You note that emotional spike, the anxiety, the urgency, and you watch the chart. Does the move happen without you? Maybe. Maybe not.
And the psychology behind this is what? What's happening in the brain?
Well, That deliberate delay gives the logical part of your brain, the prefrontal cortex, a chance to catch up with the emotional signal from the amygdala.
Ah, so you're letting the rational mind get a word in before the panic button takes over.
Precisely. You're strengthening your ability to pause and confirm even after that first emotional shot has been fired. You're letting the emotion be a signal, not the decision maker.
And we know from behavioral economics that even a brief pause, a tiny delay, can drastically reduce how much you value that immediate risky reward.
You're training yourself to tolerate the pain of potentially missing out for the long-term gain of disciplined execution.
Right.
Okay, so let's pivot from that to our tools. How we can use technical tools as psychological anchors. I'm talking about stop loss and take profit discipline.
Yes, everyone knows what they are, but the real battle is in sticking to them, adherence.
Oh, absolutely. This is where mental sabotage just thrives. It's easy to set a stop loss when you're calm, when the market is closed.
But when the price is moving toward it, that's when the little voice starts screaming, just move it down a little, give us some room to breathe.
And that's the moment of truth. The power of having those targets preset is that you've outsourced the decision. The plan you made when you were calm is making the call, not the anxious you in the heat of the moment.
And if you move that stop loss, you're essentially trading your discipline for hope. And hope is a terrible strategy.
It's one of the fastest ways to have an emotional blowout.
By holding that line, no matter how painful it feels, you're teaching your brain that the rule, the system, is more important than the immediate pain of one loss.
Okay, so we've talked about actions and tools. Let's move inward now to documentation. Let's talk about emotional journaling. And this is so much more than just tracking P&L.
Well, absolutely. If you're only tracking dollars, you are missing the root cause of your mistakes.
So what should you be writing down?
You need to record when the emotion peaked. Was the anxiety highest right before you entered? Was the greed strongest when you were halfway to your target? That's the data you need.
That granularity is where the insight is. If you see a pattern like, I always jump in 2 minutes too early out of impatience, now you have something specific to work on.
Exactly. And it's not just about the negative. You have to record the positive reinforcement too. Celebrate the moments when you successfully used patience. Research actually shows that people who do that improve their timing far more than those who only focus on their losses.
You're not just analyzing failure, you are training success. That makes perfect sense.
And that leads perfectly into the next technique, how we can embed those successes through mental simulations or visual rehearsal.
This is something you see with elite athletes, with special forces. They use this constantly.
I do.
Before you even sit down to work, you just close your eyes and you mentally practice the scenario. You see the setup, you feel that temptation rise, but in your mind, you choose the patient, disciplined response. You rehearse it.
You're basically creating a memory of doing the right thing before you've even done it. You're building stronger neural pathways. So when the real pressure hits, your brain defaults to that rehearsal.
It's like a pre-programmed override switch for FOMO.
Exactly. But let's connect this to the body. Emotions. They don't just exist in your head, right? They're physical.
Absolutely. When FOMO or fear hits, it's not just a thought. It's a racing heartbeat, tight shoulders, and this is a big one, shallow, rapid breathing.
That shallow breathing sends a direct signal to your brain. We're in a fight or flight situation. Panic mode.
Which is why our next technique, conscious breathing and physical awareness, might be the single fastest way to hit the psychological reset button.
It really is. Before you act, just notice the tension. Is it in your jaw, your shoulders? Then take one deliberate, slow, deep breath into your belly. Hold it for 3 seconds and exhale even slower.
Just 30 seconds of that can completely change your state.
It activates the parasympathetic nervous system, which manually overrides that panic signal. It shifts you from that reactive state into a calm, rational one. It's a performance hack disguised as a simple breathing exercise.
And to make that override capability even stronger, you need to practice patience when the stakes are really low.
Yes, this is where micro-patience exercises come in.
These are tiny, mundane challenges in your daily life. We're not talking about anything big here.
Not at all.
Right.
For example, you're microwaving your lunch. When the timer hits 0, just wait. Count to 5 in the silence before you open the door.
Or your web page is loading slowly. Consciously wait 3 extra seconds before you hit refresh.
The value of this is so profound. In dozens of these tiny moments every day, you are teaching your brain that waiting is safe, that delayed gratification won't cause a disaster.
And that ability to wait 5 seconds for a microwave, That translates directly to being able to wait 5 minutes for a market confirmation.
It's the same mental muscle.
Okay, let's pull all these threads together into an action plan. Let's contrast the two responses when a perfect setup suddenly appears on the screen. First, the impulsive one.
The impulsive response. The setup appears. Adrenaline spikes. Your mind screams, don't miss this. You enter early, before confirmation. Now you're exposed. If it moves against you, you emotionally move your stop loss, making the potential damage even worse. It's high stress, low certainty.
Okay, now the discipline response. Using our training, the setup appears. You notice the tension in your shoulders and you label the feeling. This is impatience. Take a deep breath, the mini reset.
Then you engage that 3-minute pause. You watch, you breathe, you verify your plan, and only then, if everything still checks out, do you enter strategically with your preset stops and targets. You exit calmly, much less stress.
The key, though, is what happens when that impulse strikes, even after all this training. Because it will. Even pros feel it.
Relapse is part of the process. It's all about how you manage it.
So when impatience hits, don't judge it. Just follow the steps. 1, recognize it. There's that old feeling. 2, label it. Impatience. Just naming it reduces its power.
3, breathe and pause. And 4, follow your system. Let your system override the feeling.
For an immediate takeaway you can use today, commit to that 3-minute pause. Every single time a potential entry appears, set that timer. Just watch, feel, and breathe, then act.
That simple delay is incredibly powerful. The main takeaway here is that patience isn't a personality trait you're born with. It's a muscle. It's built through consistent, deliberate repetition.
You are literally rewiring your brain to make discipline your default setting. You're taking FOMO's hands off the steering wheel.
And remember, this isn't about eliminating your emotions. That's impossible and probably not even desirable. It's about redirection. It's about choosing calm over panic, clarity over impulse.
So a final thought for you to take away. If waiting isn't a punishment, but is actually essential preparation for a better result, what single micro-patience exercise totally unrelated to your main work can you commit to starting right now to strengthen that underlying decision-making muscle? Think about that today.
All right, welcome back to the deep dive. Today, we're drilling down into trading psychology, but we're going way beyond the basics.
Yeah, we're moving past just, be patient.
Exactly. We're looking at the actual mental engineering you need for elite performance. It's like we're trying to find the brain's operating manual for when things get volatile.
That's a great way to put it. This is all about long-term emotional conditioning. It's not about just stopping one bad trade. It's about understanding that your brain interprets every tick of the market through its own filters.
And those filters, those shortcuts, are often working directly against you.
Absolutely. So our mission today is to give you the tools to train your mind for consistent, rational decisions, even when, fear and greed are just screaming in your ear.
Okay, let's unpack that. It feels like we're trying to hack our own evolution. Our brains have these things, cognitive biases, which are just unconscious shortcuts to make decisions faster.
Which is great for, say, running from a lion.
Right, but terrible for financial analysis. So what are the really sneaky biases that end up costing traders the most money?
Well, I think the most dangerous ones are the ones you don't even realize you're using. You just rationalize them every single day. Let's start with a big one, confirmation bias.
Yeah.
It's not just noticing information that supports your trade. It's actively and subconsciously ignoring anything that suggests you might be wrong.
So you're only reading the one headline that justifies your position, even if there are 10 others saying the opposite.
Precisely. You stop being an analyst and you become an advocate for a decision you've already made.
Wow. Okay, what's next?
The real powerhouse of irrationality. Loss aversion.
I've heard of this one.
And the insight here is the paradox it creates. You feel the pain of a loss about twice as intensely as the pleasure of an equivalent gain.
So it hurts way more to lose $100 than it feels good to make $100.
Exactly. And because of that, you become risk-seeking when you're losing. You hold on to a losing trade way too long, just hoping it'll come back.
The I'll just wait till it breaks even trap.
That's the one. And at the same time, you become risk-averse when you're winning. You snatch a small profit way too early because you're terrified of giving it back.
So loss aversion basically makes you hold on to your garbage and sell your gold. That's powerful.
It completely inverts proper risk management.
So if loss aversion is about being stuck on your entry price, what about being stuck on more recent events.
That's a perfect transition to recency bias. This is where you give way too much weight to the last few things that happened.
So if you just took 3 losses in a row,
You freeze up. You see a perfectly valid setup according to your plan, but you hesitate because the pain of those recent losses is just too fresh in your mind.
and the opposite is true too, I imagine.
Oh, absolutely. A winning streak leads you straight into overconfidence. You start thinking you can't lose, so you take bigger risks, you bend your rules.
And that's usually right before a big fall.
Almost always. And one more to add to this lovely list is anchoring.
Anchoring. What's
Yeah.
that?
That's when you get fixated on a specific past price. Maybe it's the price you bought at or an old support level. You rely on that number and you ignore all the current data that shows the market conditions have completely changed.
It's like you're trading yesterday's market.
You are. And just recognizing these enemies is, it's the first step. But recognition alone isn't discipline.
Right. Knowing isn't doing. So what are the practical in-the-moment tools we can actually use to fight back? We need something to create that mandatory delay between the impulse and the action.
And the single most powerful tool for that is a decision checklist.
That checklist. Go.
Now, this is less about just ticking boxes for rules you already know. It's about creating an external process that forces an override on the impulsive, emotional part of your brain.
So it's about forcing the rational brain to take over. But how much time does that really take? Is 15 seconds enough to stop that, that emotional surge?
It absolutely is. The goal isn't the time, it's the interruption itself. You force your prefrontal cortex to engage. You have to ask, is this setup valid? Have I waited for confirmation?
Am I feeling FOMO? Am I feeling greedy?
Exactly. Am I risking more than I planned? Am I just reacting? Even that 1-minute pause, sometimes less, it dramatically cuts down on errors.
That interruption is everything.
Yeah.
So we've got the checklist as a logical anchor. What about something that targets the emotion itself?
This is a more advanced strategy, but it's incredibly effective. It's called emotional labeling.
Labeling, you mean just
Yeah,
naming the feeling?
just naming it. When you feel that anxiety or impatience building up, you just say to yourself silently, this is fear or this is impatience.
Why did that work? It sounds almost too simple.
It works because when you assign a name, a linguistic label, to a raw feeling, you shift your brain. You go from reacting unconsciously to observing consciously.
You create some distance.
That's it. You create distance. The feeling is still there, sure, but you've taken away its power to drive your actions. You are no longer being the fear, you are simply observing the fear.
It's like moving your brain from that fast emotional gear into the slower, more rational one.
And to really lock that in, there's another simple tool. We call it the 5-second rule.
Okay.
When you feel that overwhelming urge to jump in early, to move your stop loss, to just do something impulsive, you just silently count down. 5, 4, 3, 2, 1.
Just a tiny timeout.
A micro timeout. But it interrupts that automatic knee-jerk response. It gives your rational brain just enough time to ask, is this decision based on my strategy or is it based on my fear?
And 5 seconds could be the difference between a good entry and a costly mistake.
Often it's everything.
Okay, this is where it gets really interesting for me. Let's put this into practice. Let's imagine a scenario.
Let's do it.
You're trading, say, a volatile currency pair. Your plan, your very solid plan, says you have to wait for the 1-hour candle to close to confirm a breakout. But the market spikes 20 pips early, right towards your entry zone. Panic starts to set in. You feel that FOMO.
The untrained trader is toast here. That emotional spike completely hijacks them. They abandon the plan, they chase the price, they enter early.
Because they're terrified of missing the move.
Exactly. And what usually happens, the price does a quick reversal to retest the breakout point, and it hits their stop loss, which is now way too tight. It's a totally unnecessary loss.
Okay, but now let's look at the trained trader, the person using this mental architecture we're talking about. What's going on inside their head?
So the trained trader feels that exact same pressure, that same mental noise, but instead of reacting, they observe. First, they label it, this is fear, this is impatience.
Step 1.
Then they start the 5-second rule countdown. That gives them the space to pull up their checklist. First question, is the candle confirmed? The answer is no.
The answer is no.
So they wait. They manage that internal chaos by focusing on the rule, not on the price wiggling on the screen. Then the hour closes, the setup is confirmed, and they enter at their planned price. They've completely neutralized the emotional attack.
That just perfectly highlights the difference, doesn't it? It's not about predicting the market. It's about controlling your reaction to the market.
That's the whole game.
But doing that all day, it takes energy. It's draining. How do you manage the stress that just wears down your judgment over a long session?
You're right, stress is the amplifier for every single one of those biases. So consistency isn't just about your trading plan. It's about physical and mental maintenance.
The boring stuff.
The boring but critical stuff. Scheduled breaks are non-negotiable. You have to step away from the screen every 60 to 90 minutes, go for a quick walk, stretch, anything to reset your nervous system.
And I'm guessing the really basic things like water and food matter more than people think.
Oh, massively. If your blood sugar is low or you're dehydrated, your emotional volatility goes through the roof. And even just 5 minutes of mindfulness or meditation can do wonders for your focus. You're trying to manage a high-performance system, your brain. You have to give it the right fuel.
But, mistakes are still going to happen. Even the most disciplined trader takes losses. So when we talk about self-compassion, how do you do that without just making excuses for bad trades?
That is such a critical question. Self-compassion is not self-indulgence.
Right.
Indulgence says, I made a mistake, it's okay, rules don't matter. Self-compassion says, I made a mistake, that feels painful. I will not let this pain cause another irrational decision. I will analyze what went wrong without beating myself up over it.
So you separate the action from your identity.
You separate the action from the self. That lets you learn instead of spiral. And that's what builds the mental framework for the long term.
So if the checklist and the labeling are the immediate in-the-moment tools, what's the long-term system for building that real permanent resilience?
The system is all about daily reinforcement. It's about turning these practices into unshakable habits through rigorous trade journaling. And I don't just mean writing down your entry price. You need to write down your emotional state. What bias did you feel in that moment? Then you need weekly reflection. Look for the recurring patterns.
I get impatient on Tuesdays or something like that.
Exactly. You can also use mental visualization. Before the market even opens, rehearse your setups, rehearse your discipline reactions. You're training the response before you even need it.
It's like you're building psychological muscle memory.
Yeah.
The rational response eventually becomes the automatic one.
That is precisely it. Over months, what you'll find is the emotional spikes get smaller, loss aversion becomes manageable, and patience, real patience, becomes your default setting. That's the edge.
So let's try to pull this all together.
Yeah.
What is this full system for staying calm and rational?
Okay, the mastery system is layered. First, it's a deep awareness of your specific triggers and biases. You have to know your enemy. Second, you need the practical in-the-moment tools. The checklist, the emotional labeling, the 5-second rule. Those are for immediate intervention.
Your first aid kit.
Your first aid kit, I love that. Third is consistent stress management, both physical and psychological. And finally, it's the long-term conditioning through journaling and reflecting on your patterns.
A market is always going to be volatile. It will always challenge you. But you can't control the price. You can only control your reaction. Your emotional mastery really is the ultimate edge.
It is. And here's a final thought for you to really think about. The skills you develop doing this radical patience, the stress management, the intense focus, the emotional resilience, they don't just improve your trading account. They fundamentally improve your decision-making and your quality of life everywhere else. This knowledge is universal. So the next time you face any emotional spike, whether it's in the market or not, just remember the process. Pause, breathe, observe the emotion consciously, and then act from your strategy, not from your impulse.
That is the foundation of mastery.
If you found today's lesson helpful, press like. It helps us create more in-depth trading psychology lessons for you.
Subscribe to English Speak Pulse and turn on notifications so you never miss an episode. We release practical long-form lessons that improve both your trading skills and your English at the same time.
Comment below and tell us, which trading emotion challenges you the most? Fear, greed, impatience, or FOMO? We'll make future episodes based on your answers.
And don't forget, download the free Trading Psychology Workbook in the description. It's packed with exercises, checklists, and journal templates to strengthen your mental discipline.
Keep practicing, stay disciplined, and see your trading and English skills grow together.